everybody. This is 𝙁𝙁𝙀𝙎 with the Freedom Report, and I'm back on New Year's Eve. That would be December 31st, 2024, to record my first video in a few weeks. I'll get into later videos on the channel as to why that is the case, but I've been traveling a lot and needed to take a bit of a break from recording, but I'm back, and I will do content, and we're going to do a long one today. Since I haven't covered the markets in a while, I'm going to do gold, silver, the US dollar, some stories, and the market all in one. It's going to be a long one. We're going to try to get this out as early on New Year's Eve as we can, and we're going to let it sit there the rest of the week so you guys can go view it. I highly encourage you, if you want to see some of my other content, to go look at Capital Cosm, a video I did a week or so ago. I think we reached about 100,000 views or close to that in the first week. That one I gave a really good market overview, which I'm going to try to replicate on a video probably later this week or early next week and give that to you here on our channel. But without further ado, and without doing a long intro, because I know it's New Year's Eve, we're going to jump right into the presentation, and I got a ton of stuff for you guys. So let's get right to it as we load up the screen. We're going right to economic data. This is the Chicago Business Barometer, which came out this week, telling us that we have issues. The Chicago Business Barometer in December slipped 3.3 points. Here, let's highlight this. We'll go that way. And we'll make it a little bit bigger for you. All right, if my browser will, I think I'm loaded up on memory. Here we go. Chicago Business Barometer slipped 3.3 points to 36.9 in December. This is the third consecutive monthly decline, with the index at its lowest since May 2024 and below the 2024 average. The decline was primarily driven by a fall in new orders, with production also lower. Increases in employment, supplier deliveries, and order backlogs restricted the downward move. So there were some positives in there, although the overall business index in Chicago, in that sort of eastern Midwest area, if you will, is down. No surprise there. Talking about consumer confidence, it was dented by stock market worries and threat of Trump tariffs. I'll talk about the tariffs here in a second. The numbers. A post-election pop, according to MarketWatch, in consumer confidence fizzled at the end of the year, owing to worries about the U.S. stock market and potentially higher cost of living as a result of new tariffs. The index of consumer confidence dropped 8.1 points to a three-month low of 104.7 in December. Now, at the end of the day, yes, the tariffs could be negative. Tariffs historically have not been wonderful. It may be a short-term solution to deal with some of the issues we have going on now, the trade imbalances that we have and things like that. And, you know, in addition to sanctions, it can be a positive policy in the short term, but it tends to have negative long-term consequences. It tends to affect the U.S. account, the current U.S. account, the value of the dollar. It tends to have other countries do the same thing to us in terms of their tariffs on our goods. And I mean, they could just be a tit for tat thing. In the long run, it doesn't lead to any sort of market equilibrium. What really needs to happen in the U.S. is we go back to manufacturing, we cut all of our debt, and we strengthen the U.S. dollar the old-fashioned way. The tariffs are always a short-term solution. It's a big thing that Trump likes to do because as president, you have 4 years. But the long-term damage from tariffs actually can be negative on economy. Lots of studies have been done on that. Not saying that we shouldn't issue some, but long-term what we want to do is we want to fix the economy. We want to fix manufacturing and production. And we want to lower the overall amount of imports. And we want to bring our manufacturing back and bring ownership back to the United States, which would fix our current account balance faster without the negative effects of being in trade wars with people due to tariffs and sanctions and that type of thing. 2-year U.S. manufacturing slump shows little sign of ending. Another article, according to MarketWatch. They say durable goods orders fall for the third time in 4 months. The report comes out a day early following Christmas Eve executive order by Biden. American manufacturers might be more optimistic about ending a 2-year slump after a business-friendly administration under President-elect Donald Trump takes over in January, but they're ending the current year on a sour note. Orders at U.S. factories fell 1.1% in November to mark the third decline in the past 4 months. Economists polled by Wall Street Journal had forecast a 0.3% increase, so that's a miss of 1.4% of what economists thought. And if you go back to consumer confidence falling, it seems like we're getting signs that we've got this downturn in the economy at the end of the year. Durable goods orders slipped and narrowed 0.1% if transportation, automobiles, and planes are omitted, the government said. So automobiles and planes were a big part of that decrease. Those big end orders that would have to do with the health of the transportation industry, with goods movement, with travel, which often is a reflection of disposable income. So you can see consumers a little stressed or buying a little bit less. and they're traveling a little bit less, which is really shown in those indexes. Wanted to go to the markets, going to go to CNBC. It's an easy one. See the market indexes. They're down today. The S&P 500 at time that's reporting about 3:30 Central Time on 12/31/2024 is down 25.31 points. The Nasdaq's down about 176 points. The Dow Jones is down about 29 points. They've done pretty well this year overall, but coming down to end the year because of some of the negative move. If you look at the bond markets, rates are in the mid fours on the 10-year. The 10-year is at 4.573. The 2-year at 4.24. No longer yield curve inversion, although it was yield curve inverted for 2 years, which means we're headed to recession. We're actually in one. If you look at real numbers, real GDP and real inflation, looking at nominal numbers, we're not there yet, but we know because of the bond market inversion of the 2 and 10-year for 2 years that it's coming and it's here. Bitcoin got over 100,000 back a little while back, about a month or so ago. Now it's trading at 93,541. I think it was at 106 or something like that for the high. Overall, the cryptos have come down a bit to end the year. A lot of markets are kind of trading off a bit, especially the alternative markets like Bitcoin and gold are really trading off from where they were. But even some of the stock markets trading off, and the bond rates have gone up a little bit. So that's signaling a little bit of weakness in the economy, a little bit of people pulling back. Maybe they're selling some of their alternative monetary assets, alternative assets like gold and Bitcoin. Definitely a sell-off going in the derivative market. Gold and silver. We'll talk about that in a minute. But overall, a little bit of trepidation in the market as we head toward the end of the year. Sometimes it's just selling to take profits on things, especially with a weak consumer confidence, a weak consumer base. But also, I think it's a sign of the treasuries being not in great shape. And we've got an article here about cybersecurity in the treasuries. The U.S. Treasury, according to CNBC, says its computers were hacked by a Chinese threat actor in a major incident. This is an article that came out yesterday. Quick quote from CNBC. The U.S. Treasury Department said a state-sponsored Chinese hacking operation was able to access third-party software to tap into desktop computers of Treasury employees in what the department is calling a major incident. In a letter seen by NBC News, 𝙁𝙊𝙇𝙄𝙀𝙀, Assistant Secretary for Management of the U.S. Department of the Treasury, wrote that the office was notified on December 8th of the breach. The letter is addressed to Senator Sherrod Brown, a Democrat from Ohio, and Senator Tim Scott, a Republican from South Carolina, the chairman and ranking member, respectively, of the Committee on Banking, Housing, and Urban Affairs. The information accessed by the threat actor included unclassified documents, according to the letter. China denied the U.S. allegations. Quote, China consistently opposes all forms of hacking as firmly against the spread of false information targeting China for political purposes. Ministry of Foreign Affairs spokesperson Mao Ning told reporters at a daily briefing, I'm going to break from the article for a minute to tell you about Chinese hacking. They're one of the biggest hackers in the world. We know it. Most security firms have documented it. When I was in cybersecurity for 8 years, I can tell you right now, a lot of our investigations led straight to China. So this is all bunk. This is just posturing by the Chinese. I'm not saying that this is guaranteed that this was done by the Chinese, but we've seen it, and we've seen it for 30 years. So for the Chinese to issue a statement like that, that's a load of complete crap. We'll see if more comes out on this particular issue on who is being blamed. So far, they're pointing at the Chinese. Hardcore, back to the article, Hardcore wrote that the U.S. Treasury was told by third-party software service provider Beyond Trust that a threat actor had gained access to a key used by the vendor to secure a cloud-based service used to remotely provide technical support for Treasury Department officers. In other words, on desktops, which is the average computer you use, like you're using at home or using in an office, not servers, but end user desktop type machines, a lot of times there's a third-party security software centralized that's used for troubleshooting or issuing updates or tracking, security vulnerabilities or that type of thing. Sometimes it's for remote IT workers to get in and fix things or diagnose computers because they can't be everywhere at once when you got people spread out all over the place with thousands or millions of desktops. And certainly Treasury Department's a big organization. It makes sense to have it. Most organizations have it, whether government or private. And it looks like that there was a risk there that allowed people. Now it says unclassified documents, but it could, even if it's unclassified, doesn't mean it's not critical information. You can have unclassified documents that are not classified because they're expected to remain inside, but it could still have key information about Treasury operations. So that's something definitely to follow there. I wanted to highlight some things I've been putting out over X. I know that I haven't done a video here in 3 weeks on YouTube, but if you ever want to follow me, I'm always on X because it's easy to produce that content. Even when I need to take a break from videos, doing other things in the background, I always come to X and the community channel on YouTube. So I've posted a lot of similar stuff on the community channel on YouTube, even though I don't do videos. So if you ever see that, head over to X or hit the community little channel button there on my YouTube profile, and you'll see a lot of this. I posted, this is one of the most popular tweets I've done in a while. This is a chart of the S&P 500 price to book ratio exceeds the March 2000 high, and you can see it's the highest basically since the Great Depression. Here's the title that I had. Stocks have not been more overvalued dating back to the Great Depression when compared to the actual book or accounting value or their actual real worth since the Great Depression. Let that sink in. What do you think comes next? Now, some people, in the comments were like, well, book value doesn't matter anymore. We're looking at forward earnings. In other words, you're looking at made up fairy tale values for what the stock market should be, because the stock market is a made up fairy tale market. And they're not actually looking at what the assets of these stocks and these companies actually are. But I'm telling you right now, this is important because we've been in one of the biggest bubbles in the history of the U.S. or any stock market in the history of the world of any nation ever to exist on planet Earth since we've recorded financial data and humans have been able to write either on stone tablets, on walls, or on paper, or on computers. One of the biggest in the history. And if you don't think that book value matters, if you don't think that actual value matters, you're not paying attention. And people say, tech, it's creating all this IP, it's all this stuff, great. Value the IP and put it on the books. But to sit here in fantasy land and say that this is not going to come home to roost, excuse me, I'm sorry. Every single time this number has gotten this high, we've had a major recession. And yes, this is another predictor of a recession. I don't care what anybody says. And I don't care about your stupid fantasy land numbers about forward earnings. It's all made up garbage that people don't even know because it's forward, meaning we don't see the future. And I'm sorry, but that's not the way to actually value the stock market at a current point in time, especially compared with historical performance and compared with what it's producing now. Forward P&Es don't do it. This is a better way. And I realize that book values are inflated and there's IP and all this mysterious goodwill and all, I was an auditor for years. I'm telling you right now, book value matters. And if you want to know how bad the stock market's going to crash, book value is one of the indicators. Price to earnings ratios, others, other valuations are there, net asset value. But price to book is important. I don't care what anybody says. And when we go to a stock market crash, a lot of these traditional measures, what would be considered these value measures, real value measures, not fancily made up, we're printed more dollars than ever, and so it drives everything through the roof. And when the dollar comes crashing down, you're not going to actually get that value in the stock market when it crashes. We need to go back to some of these old values if you want to know where the stock market could eventually turn over to when you look at history. Not because I think so or because I said so. When you look at history. History is telling us overvalued. Price to earnings ratios are also overvalued across most industries, especially the tech, but a lot of others as well. Now you get consumer staples and commodities, not so much. Those traditional value investments, the things that Buffett used to invest in and the value investors used to invest in before we had this made up fantasy land of printing as many dollars as we want, getting to $37 trillion in debt. Another one I posted was the probability of recession in the second half is very high. Thanks to Bravo's research for this screenshot. Extreme yield curve levels seen only 3 times since 1960 where each time was a severe recession. The gray bars are a recession. The yield curve is a 2 and 10 year, which I addressed earlier when I was talking about the bond market. When the shorter term yields on treasuries are higher than the long-term yields, okay, that means oncoming recession. It always has in history. And this chart is telling us very high chance 2025, a recession based on this indicator. Every single time in history it's occurred in modern finance, period, end of story. So all the sunshine pumping about the stock market, all the sunshine popping about treasuries, all the sunshine popping about the dollar, which I'm going to get in the dollar here in a moment. Don't believe it. The traditional indicators with 100% accuracy are saying recession, recession, recession. If we're not already in one now, which we are when you look at real values, certainly nominally at the fantasy land values that the government likes to use, a lot of, what call these fake economists, Keynesian economists like to use, are going to point to a recession, and it's coming. Okay, it's coming. Another one on Twitter. This is a really good one. This is done by Gordon Johnson. It says very simple. Secretary Yellen recklessly issued a massive amount of short duration bonds recently, which worked to drain the overnight reverse repo account. Okay, so you look at reverse repos, it's the lowest it's been since March of 2021, right after we had that repo market crash, after the COVID pandemic, before they started pumping liquidity. So it's down. And usually when the reverse repo markets get this low, it's an issue of short-term liquidity. But listen to the rest of what he says. It did drive U.S. liquidity higher. You can see by the amount of bill issuance. You can see that this is the Yellen pivot down here. And, since she got in, and T-bills outstanding as a percent of total U.S. government debt way up. And versus the S&P, it's almost followed the S&P. So in other words, we've had this huge inflation of the Treasury market, this debt that we're not going to be able to service, about almost the same as the stock market. So if you think the stock market's in a bubble, guess what? The amount of treasuries we're not going to be able to pay off is in the biggest bubble of all time in the United States. In total dollar terms and as a percentage is very extremely high when compared with all other times in U.S. history, since we've been issuing this treasury debt in the fiat system since 1913. And he says that it's driving U.S. liquidity higher on the longer end of the curve, pushing risk assets higher, i.e. stocks and things like that, even real estate as well. And as that liquidity purchase stocks indiscriminately. If incoming Treasury Secretary S. Bessent does what he says he'll do, what he said publicly, and issues longer duration debt to satisfy coming maturities, that will work to actually drain liquidity from the markets as bank reserves will be used to buy debt versus buying stocks. This will be very bad for risk assets. Okay, so it's going to pull stocks down. You're going to have a choice about where to get your yield. And if they push the bond market up, then it's going to pull money away from stocks. Overall, I think what's going to happen is you're going to have that seesaw until something breaks, and then it's all going to go. But in any case, I thought that was a cool tweet about what you could see in the next 6 months to a year in those markets. Going on to gold price as of about 3:42 p.m., according to goldprice.org. On the last day of 2024, according to the Gregorian calendar, maybe not the real one, but the Gregorian. We'll save that for another podcast. Gold is up $18.25 today. Silver's down 11 cents. Silver trading 28.84. I wrote that this is absolutely criminal. There's no way that silver should be that when you look at supply and demand. But in any case, that's what it's at. And we're going to talk about the derivative markets. We're going to get into the gold chart. Here's my Fibonacci's. That's basically a 50-year chart of key trading signals that these derivative paper traders are going to look at in terms of where gold is going. Is it in a bull market? Is it in a bear market? Are we going to trade it up or are we going to trade it down? And I want you to notice something. We had the fastest rise of a 50-year breakout cycle in the last 50 years in gold, or the fastest breakout cycle in the last 50 years in gold this year. And I'll show you an article where gold is up something like 27% on the year, and it's its best year since 2010. In fact, I'm going to show you that right now. According to Yahoo, gold heads for biggest gain since 2010 in a mixed year for metals. Gold is heading for its biggest gain in 14 years with a 27% advance, fueled by U.S. monetary easing, sustained geopolitical risk, and a wave of purchase by central banks, according to Yahoo Finance. While bullion has ticked lower since Donald Trump's sweeping victory in November's U.S. presidential election, its gains over 2024 still outstrip most other commodities. Base metals have had a mixed year, while iron ore has tumbled and lithium's woes have deepened. The varied performances over 2024 highlight the absence of a single overriding driver that steered the complex's fortunes, while also putting the spotlight on how metals, both base and precious, may fare next year. For 2025, investors are focused on uncertainty around U.S. monetary policy, potential frictions from Trump's presidency, and China's efforts to revive growth. Gold's strong gains this year, which have seen the precious metals set a succession of record highs, may signal a possible shift in the market's dynamics, given that they have come despite a stronger U.S. dollar and rising real treasury yields, both typically headwinds, meaning recession. The precious metal has been as remarkable as it's been relentless, making it my biggest market surprise of 2024, David Scott, an analyst at StoneX Group, said in a note. The gold game looks to have changed. In other words, a lot of market analysts are seeing this. Even with the fade at the end of the year, they're still looking at the fundamentals. And they're saying gold could do good in 2025, so don't get discouraged. These market analysts see what happened. And just because it faded a little bit at the end doesn't mean they're giving up. They're looking at it going, wait a minute. We might be in a nice little trend for gold here, given treasury risk, geopolitical risk, market risk, all those things that we talk about. Let's say other metals have struggled in part because of China's prolonged economic slowdown. The LMEX index of 6 metals on London Metal Exchange is on track for its modest annual gain, with softer Chinese demand offset by flashes of supply stress, especially in copper and zinc. That means they're not mining enough. So it's kind of popped it up a little, even though overall demand has been down. Iron ore slumped as weak construction activity plunged China's steel industry into crisis mode. And lithium, used to make batteries, is on track for a second steep annual decline, as serious and ongoing global supply gut was compounded by turbulence for the electrical vehicle industry. Going back to the chart. So we talked about gold versus commodities outshined most, if not all of them, It did well. Market analysts still think it's going to do well. Let's look at the chart. We've seen a strong downtick from October, and I'm going to show you exactly why that happened. It's a derivative trade. It's a paper trade. It has nothing to do with physical supply and demand, because we're going to look at the DXY, which is the dollar index chart, which is a dollar against other currencies, not the dollar against gold, not the dollar against inflation of prices, the dollar, the fiat dollar against other fiats. And it's been rising a little bit, even though its overall trend is down. And when the dollar rebounded to its 200-day moving average against other fiat currencies, not against inflation, not against gold, not against real goods, not against purchasing power, against other craptastic fiat world currencies, a basket of about 5 or 6 others, that's when gold started trending down. It's a paper trade based on people looking at the DXY and looking at the dollar. Has nothing to do with physical, has nothing to do with physical demand, has nothing to do with risk. It is a short-term paper trade, okay? So it began trending down on October 1st. Now let's look at a DXY chart. I'll get to the short term, then the long term. Short term, on what day did the DXY pass back through its 200-day moving average? It was on Friday, November 1st. At the bottom in September and October 1st, it really bumped up against the 200-day moving average. So in other words, it fell down below its 200-day moving average. Gold had been going up. And in fact, if you see the dollar compared to other fiat currencies have been very strong. And then it started to come down this year in 2024. And because it was bouncing around that 200-day moving average, gold went like that, right? People switched from demanding dollars to demanding gold physically and in the markets. Remember in November, we had that report from Swift that said for the first time, basically since the 1970s, that I could tell that the US dollar was less than 50% of international wire traffic. Less than 50, not 58, not 62, less than half. The dollar was not the majority. It was still the plurality. It was still the best individual currency, but it was not the majority of international currency transactions in the SWIFT system, which means that dollar demand is going down in real time. Now, overall, people still hold more US dollars in global reserves than they do all the other currencies. But this is a sign that that dam is breaking and that people are demanding less dollars. So even though the dollar index is up against other currencies, it's starting to roll over, okay? And it's going to roll over more. So even though the dollar index is now above its 200-day moving average, and at the same time that that happened, it caused gold price to fall, that is a short-term trade. It is a short-term trade. So you're seeing this fade at the end of the year, and people are panicking, oh my God, nobody wants gold. No, it's a short-term trade based on the dollar. Now let's look at the overall trend of the dollar if we go back to like the 1970s. The 1970s is when we got off the gold standard. So what happened is the dollar index floated up until the early 80s, about the mid 80s, and then it's come down, okay? So the dollar index has come down. This is this red trend line. And since we looked at the high in the 200-day moving average, which occurred in December of 86, it's also fallen down per the 200-day moving average, which means since 86, which would be 38 years? Yeah, 38 years. In the last 38 years, the dollar has depreciated according to its 200-day moving average, meaning any 200 days you looked at, the dollar was trending down for the last 38 years, meaning overall in the long term. Doesn't mean it didn't go up. It did go up and pass its 200-day moving average. Starting over here in May of 1996, it came back down in 2002. That was after the big tech crash in 2000. And then it weakened until about December of 2011, when it finally broke through its 200-day moving average. It stayed up there until the COVID crisis. And then in 2022, it finally broke its 200-day moving average and stayed up, and then finally tested it 3 times. Boom, 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 here, here, and here, if you look right here. And then finally, it came up in October 2023, and then right there in October, at the end of October 23, sharp crash. It stayed down below its 200-day moving average. That caused gold to surge since the end of last year to this year. And then once that dollar index finally broke back up, it caused gold to come off. This is a short-term technical trade. But you look at the long-term charts, gold is way up. Let's look at the gold chart. If you look since 1971, it's not going to have it on this chart, but if you look since 2000, it's way up. It's beaten all the major market indices. Since 71, it's way up. It was like 35 back then when it was unpegged from the dollar, and it's just gone, you saw it go to 1,800, then to 1,100, then to 1,900, then to 27 and 60 high, and it stayed in that $2,500, $2,600 range. but look at the DXY. The overall trend, okay, is down since the 80s, and against a 200-day moving average, it's lost. It's lost. So it's 38 to 40 years. The dollar hasn't recovered to where it was 38, 40 years ago. So once we got off of that gold standard, we started printing dollars, it just got worse. And this is against other currencies. This isn't against gold. This isn't against inflation. The DXY is a measure of the dollar against other currencies. So other currencies have done better than the dollar the last 38, 40 years. And so even though the dollar is still the world reserve currency, you saw that World Gold Council study I had last year in 2023, where we knew that the central bank said we're going to drop below 50% of the dollar in world reserves. And in November this year, it actually did in the actual real-time wire transfers, in that month's wire transfers, in that month's trade. Okay, that's at a point in time, but overall, the dollar reserves are coming down. So the dollar is weakening, which means gold long-term is going to go up. This is a short-term deal. I've said that 100 times. And gold's going to go back up. It's a dollar trade right now. It's a dollar world. But as those treasury issues start to become bigger, as the economic issues start to become bigger, you're going to see gold go back up. But, we had the fastest rise basically in 50 years history in terms of just almost a straight move for gold. If we go back to the gold chart, it had to come back down. Do I think it's going to come back down to the $2,300 range and come back in that lower Fibonacci or lower trading level? It could. I don't expect it to happen. Like, you would have to see amazingly positive economic news, no bank failures, no new geopolitical risk and all that for the first quarter of 2025 for gold to come back that far from where it is right now. I don't think it's going to happen. It could, but long term, with the dollar weakness of treasury debt, the deflation in the economy, the wars are ongoing, I don't see that happening in gold long term. So I spent a lot of time on the gold and the dollar just so that you knew what had been happening to gold, but not to be worried long term because fundamentals haven't changed, okay? Now on to silver, it's come back down under this little trading Fibonacci, this little trading range, and it's tested it twice, boom up and boom back down. I think silver is going to fade a little bit more. You could trade back down that $26, $27 range. I don't think it'll stay there. Silver's a little bit more volatile. It'll come down. People will scream bloody murder. Oh my God, it's $26. What do we do? Don't worry about that. Silver is very short term in terms of supply and demand. And we've had supply shortages, but there are enough on the exchanges to kind of keep it up, to keep it to where, but eventually that will break. But I think really what the long-term driver of silver is going to be, first, gold's going to break up again and pull silver higher. And then the supply deficit in silver eventually, assuming we don't hit a worldwide deflation, we just stop using it. But even if we do a percentage, we're still going to be short in mining. So I still think that mining supply to deficit that we pull out using in the economy is going to moderate a bit because of worldwide deflation. But in the 3 to 5 year time frame, that's going to explode. But I think in the 1 to 2 year time frame, gold's going to go up because of economic crashes, geopolitical risk, war, and that's going to pull silver up. So silver could come to 25, 26. Wouldn't surprise me. If it does, I'm not worried about it from my perspective because I think medium long term, 1 to 2 to 3 to 4 years, it's going to go up. And I know I've been saying that like a broken record, like Rob, blah, blah, blah. This is derivative trading. Understand the difference between derivative and fundamental with the physical. The fundamental physical with the gold and silver has not changed. And you're going to see these dips when you have the derivative markets controlling it as a trade short term against other things like the dollar and the treasury rates and stuff like that. But that doesn't last. And this is a market where you got to stick in it. All right, going on to the COT report. Silver, as of the latest report, as of December 24th, again, always a week behind. You see a bunch of short covering. If you look at the swap dealers here, they've dropped 2,500 shorts. Who picked them up? Well, the longs were basically the other reportables. You had a little bit of long in terms of producer merchants. So overall, the swap dealers were able to release some of their shorts and put that pressure on the rest of the market. And say, Rob, if they're able to release shorts, how does the price go down? Don't they control the market? Well, it's who's trading first and who gets who to put it in. Because think about the market. If you're going after Apple stock and it's hot right now, they just released their new iPhone, you're like, man, this stock's going to go nuts. The people, it's the amount of bids that come in, either long or short, and how they come in, at what time they come in, which drags the price up or drags the price down. It's not just the overall trade. The overall trade does it, because if you look at the swap dealers, they're almost 2 to 1 short. But they've reduced some of that short pressure while short covering and the prices come down because they've gotten people to go long and cover their shorts. It's who's bidding first, who's bidding when, and how strongly they're bidding. It is the short-term price movement. The long-term is the overall level of the position. So overall, they're still too short and they have too much risk. And overall, the managed money is long, more than 2 to 1. The other portables are long, more than 2 to 1. But in the short term, short covering, because of the way that that's put on the market, it's also options have something to do with it, because as you hit certain strike price points, people take their money and it affects the futures trade. We don't go into that too much because it's like it's hard to explain, because the way that data is downloaded is very difficult to do without the right tool. But in any case, that's basically what's happening. If we go on to gold, they've released 15,000 shorts. Well, how can the price fall when they release 15,000 shorts? Because they get people to reduce their longs. Managed money just dumped a bunch of longs. And it depends on how the banks goaded them into it. If they goaded them into the managed money, dumping a bunch of contracts all at once in 1 month, boom, down goes the price. It's who initiates, it's the strength of it, it's the time that it's done, and it's how it's done. So they're basically able to make money in the long and short of the market based on timing and things like that, which you can't see on a static chart like this, but you can see it trading. And when I interviewed people that actually were in the market, including the lead investigator, he said a lot of it has to do with timing and who's coming in and how they're coming in as to how this market. And that's true in the stock market. People really want to bid the heck out of AMC stock, or, any stock that they want to. It depends on how they come in, when they come in. And remember, in all these derivative markets, you only have to have a small smidgen of something move the entire price. A small amount of trade can move the entire price. And that's you can see those outsized moves with a little bit of trade. We already went over this Yahoo Finance article. Last article I wanted to put is from Gata, posted over at Goldseek, and it's talking about the 50th anniversary of legalization of monetary gold in the United States. And this is something brought up by my good friend, Stuart Engler, who wrote the book Rigged. I've been talked to in a while on the channel, but I saw this reported at Goldseek and I wanted to talk about it. And it says here, quote from Goldseek, in his essay this week marking the 50th anniversary of re-legalization of monetary gold in the United States in 1974, researcher and author Stuart Engler noted the opposition by Arthur Burns, then chairman of the Federal Reserve Board. The opposition remains especially noteworthy today because some details in Burns' testimony to Congress about gold legalization on December 5th, 1974, testimony Engler this week called to the Secretary of Treasury's attention. In other words, he put the article up. And it says, Fed Chairman Burns admitted gold's competition with the dollar, but his latest successor lies about it. So we're just going to quote from the Burns quote 50 years ago. The risks associated with a reopening of the gold market extend also to the exchange value of the dollar in international markets. What are we talking about, as gold is more demanded by central banks right now and the DXY over the last 38 years? This is what he was talking about in this letter, and we've seen the slow burn off of the dollar and the slow rise of gold that eventually is going to accelerate when the dollar falls below 50% of global reserves and it continues to be de-dollarized. That's what Burns is talking about here 50 years ago. Quoting Burns, apart from sales by the Treasury, any substantial demand for gold by our citizens would have to be met by gold imports. The consequence might be a worsening of our international balance of trade and downward pressures on the dollar and foreign exchange markets. These pressures on the dollar could, of course, be checked by sales of gold from a nation's monetary reserves, but there are risks associated with this course of action. Since the precise role of gold in the international monetary system is yet to be determined, because we were coming off the gold standard, I added that little part in, it would hardly be desirable to dispose of any sizable part of our reserve assets. Clearly, therefore, various adverse consequences for our financial markets and our economy may stem from a reopening of the gold market at the end of this month. No one can now say with any confidence how serious these consequences are likely to be. 50 years ago, go back and look at the gold chart up, go back and look at the dollar down. What was Arthur Burns saying? Dollar down, gold up, adverse consequences to the dollar. You get it? He predicted it 50 years ago. The risk associated with private ownership of gold are, however, postponable, and I see no material advantage to the nation incurring these risks under present circumstances. We should be ready, nevertheless, to make prudent use of the Treasury's holdings if demands for gold threaten to have adverse economic or financial consequences. For example, if large imports of gold exerted significant downward pressure on the exchange value of the dollar, prices of imported products would rise, and this would tend to worsen our inflationary problem. Sales from the Treasury's gold stock could lessen this difficulty, and I endorse the Treasury's intention to auction. Summarized by Chris in this article, Burns first told Congress that gold would compete with the dollar as a reserve currency and store of value, and second, that this would compel the U.S. government to try to defeat the competition by intervening in the gold market to knock the price down, as by strategic sales from the U.S. gold reserve. Contrast Burns' begrudging candor in 1974 with the assertion made earlier this month by his latest successor, as Fed Chairman Jerome Powell said that gold and Bitcoin compete with each other, but not with the dollar. What has changed since 1974? Nothing. How do we know gold competes with the dollar? Gold up, dollar down. It's not gold versus Bitcoin. It's everything else against the US dollar. Okay, do you get it? And that was predicted 50 years ago by Arthur Burns, and he's correct. We can see it on the chart. So if you're worried about the short-term increase or power of the DXY according to other currencies, it's a very small blip on the chart, and yes, it does affect gold. But if you look at 30, 40, 50 years, gold's already won that race, and we've already heard the central banks say they're de-dollarizing. We've already seen the first time since I've seen in recorded history on SWIFT exchanges, the US dollar less than 50%. We know the reserves are coming off in that survey, US Gold Council survey from the US banks. We know that they're formulating CBDCs after the dollar, which is going to put a lot of control over the currency markets for the central banks and governments, which we don't want. And we know what's going on. So even though gold's come off and people are a little bit panicking at the end of the year, it's short-term price sell-off. And again, in the derivative markets, that happens. That happens when you have such a hard rise. But remember the analyst that I quoted that said, don't look away from gold right now. Nothing has changed fundamentally to change the long-term prognosis of gold. And since 2000, gold has beaten the snot out of all the major stock market indices. It's beat the returns on bonds. It's beat the returns on almost everything except for a few things that were highly risky that you were lucky if you got into. And you're one of the 1 or 2% of people that figured that out. So if you were just putting money away, it would have been better since 2000 to do it in gold. And analysts are saying that that's going to be the case going forward. So don't panic right now. Look at the tea leaves, study the markets, and understand. And lastly, understand that the plan to revalue gold in the US and to buy Bitcoin and try to save the dollar is a foolish plan. It's not going to work. Gold is the ultimate arbiter of value, not Bitcoin or the dollar, which are both fiat assets, especially with problems that both the fundamentals of the dollar and fundamentals of the way Bitcoin's been implemented, BTC Bitcoin, are not the original vision, and the dollar's not the original vision. Those have both been taken a different direction, and gold will tell the tale, not only in the United States, but around the world. And lastly, have a very good, happy New Year's Eve. Appreciate you guys for sticking with me for this long video. It's only about 38 minutes, not too bad. I actually got a lot of data in there in a very short period of time. We'll come out with an overall market view of 2025, much like I did on Capital Calls, and I'll come out on my channel and give you a nice long view. Not going to do as many charts. We're just going to address that either later this week or next week. Look forward to that. And I'll go back to doing regular videos now that I'm not traveling quite as much, doing all the recordings that we've been doing as we, jaunt around the world to 6 or 7 different cities and talk to people about gold, the dollar, and economics, which we'll have on the channel at a later date. Stay tuned for that. It's been really cool. You guys have a blessed, wonderful new year next year. God bless all of you. Love you guys. Till next time, Rob Kientz with the Freedom Report.